The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. And now, please welcome your hosts, Mark Longo, Mike Cavanaugh, and Eric Cott.
Welcome to the Advisor's Option, the program designed for financial advisors and asset managers who are interested in implementing options or adding them to their portfolios. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And I am joined, as always, here on the Advisor's Option panel by the one, the only, Mike Cavanaugh from Know Your Options, Inc. Mr. Cavanaugh, welcome back to the show, sir.
It is great to be here. You know, I coined the nickname Federal Holiday Mike on the Options Block
I don't know if we
show.
can carry that from show to show, though. We don't want to confuse the listeners.
We won't, but we are here on a working vacation in New Orleans at the Options Industry Conference, and I just don't want any of the Options Insider Radio Network to just think that...
Feel alienated, left out?
That we are not on vacation. We are working hard to get all the juice and facts of what is creating the buzz in the marketplace.
Yes, we couldn't do the option block yesterday. At least you and I couldn't do the option block yesterday. But it carried on without us. I hear it went very well. And because we were busy down here doing this. And, of course, we are at the 2012 Options Industry Conference here in New Orleans. And there's also being held the Wealth Advisor Summit right here in the exact same hotel for financial advisors who are interested in learning more about options and how to implement them. So a lot of interesting things going on from both a financial advisor and an options perspective here in New Orleans. But with that said, we're going to kick the show off, as we like to do here, with our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, and welcome to Options 101. This is, of course, a portion of the show where we dive into some options basics to help those busy financial advisors and asset managers out there get a better handle on these products and how they actually work. And on our last episode, we unveiled the mysteries of the covered call, a very, very mysterious position, also a very popular one, with a lot of advisors and a lot of retail traders and institutional traders who are looking to generate a little bit of extra income from their portfolios or looking to add a dividend stream to an underlying that they already hold. So a lot of interesting things you could do with the covered call. And now today we're going to look at the other end of that spectrum, which is instead of selling calls, we're going to be selling puts. And today we're going to be selling something that sounds a little shady, a little dubious. It's selling naked short puts. And this sounds risky, it sounds scary, and it can be if implemented incorrectly. But today we're going to walk you through some examples of why you as an advisor may want to consider selling naked short puts. And one of the biggest advantages out there for equity traders, for advisors, fund managers, what have you, when you're talking about naked short puts, is to think of them as a proxy for working a limit order in an equity. Most of you out there are familiar with that process. You find an underlying you like, you establish a price level at which you want to buy it, and you work a limit order at that price. All of us have done that at one time or another. But the notion of being paid for that process is one that can be very attractive to a lot of traders out there, and which is why selling short puts and naked short puts is such an attractive prospect to them. So let's walk you through a few examples here of where you might want to implement this approach and how it compares to just working a standard limit order. Let's look at everyone's favorite. I've made and lost fortunes in good old XYZ. I'm sure you have as well, Mr. Cavanaugh. And unfortunately, the IRS tends to not take a dim view of trying to accept write-offs on XYZ stock.
The illustrious XYZ stock is the stock that has had more stock splits, options sold out, whatever it is. XYZ has probably every instance of everything.
Every weird scenario that could possibly imagine in the options market has happened to XYZ. In some ways, it's a very unfortunate name. 10,000 to 1 reverse stock splits. It's had it all.
What would ever happen if the company figures out that they could get the ticker symbol XYZ? What would happen to our presentations?
I wonder if that one's just off limits for that. I'll have to check with the exchanges to see if that one is delisted. It's certified educational use only. So let's look at an example here in good old XYZ stock. Let's assume it's trading at $100. You're looking at it, you're interested in trading it and buying it at 95. So you have a couple of different options. You could go out and do the standard practice of work a limit buy order at the 95 price level in XYZ stock and wait till it gets filled. And if the stock drops to 95 or below, you'll get filled. If not, nothing really happens. It's pretty much a very binary event, the working of the limit order. Now, you also have some other options, pun intended, and those include selling a naked short put.
The term naked short put.
The peanut gallery is killing me here.
Well, it just it makes you think, risk.
Yes.
And at the options conference right now, you can see the professionals in the industry that understand what options were created for. We need the top-down. This is one of those situations where top-down can actually work. We need our industry to acknowledge that the perception of options and risky is not where we need to be. We need, cash-secured put writing sounds a little better.
Yes.
But we need to be able to term something as an alternative stock entry system that isn't smashing somebody in the face with a hammer that says, oh, risk.
Yeah, I agree. And one of the reasons I use that term naked short put is I'm trying to co-opt it and turn it to our dark side. People have heard it so often, they're terrified of it. I figure if we throw it around a little bit, people will understand what we're talking about. But you're right, it is a terrible term. It's completely pejorative and one that tends to turn off as many people as not that hear it.
And the important part, so the naked short put, I will revert back to calling it the naked short put. What you have to understand about it is how is the perception real? How do people lose money doing anything? So when you look at the naked short put in a cash secured setting, if the stock goes to zero when you sell that 95 put on XYZ, if you own the stock outright and you bought it at 95 and it goes to zero, 100 shares, you lost $9,500. If you sold the 95 put and got $1 and the stock goes to zero, you lost $9,400. So something that is perceived as riskier, you actually lost $100 less by selling the cash secured put than you would have by buying 100 shares. So
yeah, I think we all learned May 6th of 2 years ago that just working a limit order is inherently very risky. So people need to, I think, also just reevaluate their perceptions of risk. There's always been you just throw limit orders wherever you want willy-nilly, and it's you get hit or you don't. It's very much a risk-neutral proposition when in the truth, you're taking risks. Once you put that order out there, you're taking risks. So you might as well receive some sort of compensation or reward for that. And the example you mentioned is exactly where I was going to go. That 95 put, let's say you sell that alternative stock buying approach, aka the naked short put. You sell that 95 put for $1. Now you do collect that $1. Remember, there is a multiplier on options, and most equity options and most index options. That multiplier is 100. So you multiply that $1 you collect by 100 shares. You collect $100 for the one lot that you just sold. You sold one front month 95 put to collect 1 point or $100. So now what happens once you've done that? Well, as Mike Cavanaugh alluded to, you have a couple different scenarios. If the stock stays above 95, that put will expire worthless. You have now just collected 1 point or $100 for the risk you took by putting that order out there, by essentially stopping someone else out. And that is essentially what you're doing, and why the selling of puts is sometimes a confusing thing for people to wrap their heads around. Buying and selling options in and of themselves is confusing for people because you're not trading a tangible asset. You're trading an ethereal right to do something. That in and of itself is confusing. When you're selling a short put, you're selling to someone else the right to do an ethereal thing. That is somehow doubly confusing. But in a sense, you're essentially just stopping out that person at 95. You're telling them.
Yeah, no, the fact that you're using the term ethereal to describe it makes it even more confusing. You're absolutely right, though. So in the stock, as you're talking, I'm thinking, you pointed out the multiplier, the standardized option, so that's a risk assessment trait that was pounded into your head on being on the SIBO floor for as long as you were. What am I trading? So you have to know that the option that you're trading is a standardized option. If it's not, then you have an uh-oh. I call them uh-ohs, an uh-oh moment. Like, uh-oh, I didn't know that could happen. And usually when you have an uh-oh, it tends to not be accompanied by a vast amount of wealth. It has to do with losing. It's more tied to losing some money when you have an uh-oh moment. So just defining all the different aspects and intricacies of the put option to, the right to, but not and like you said, the ethereal part of it is a stock is binary. It goes up, it goes down. If you're long a stock and it goes up, you make money. If you're long a stock and it goes down, you lose money. So there's a whole bunch of things that are nonlinear and non-binary in the option that I think tend to make it more confusing. I think one thing that's helped me, because I wasn't born, despite what all the listeners out there think, I wasn't born with options intelligence. It's not an inherited trait. You have to learn how the intricacies of options work. So what we do with our clients and what has helped me is you take, in this instance, selling the 95 put on our friend XYZ stock, in your mind, on a piece of paper, whatever, if you're visual or non-visual, write down what happens to the price of that put if the market goes up, if the market stays flat, or if the market goes down. On the same sheet of the paper, just to the right, do the same with the stock on XYZ. What happens if I'm long 100 shares of XYZ and it goes up, stays flat, or goes down? And then you've got a spreadsheet in front of you that says, here's what I can make if the market goes up, if I'm long or short the put or long the stock. And then you will start getting comfortable with the understanding of a non-binary, non-linear derivative and comparing it to the binary underlying, and you will start seeing the trade-offs. So people get confused with options. Everybody wants to make a whole bunch of money with no risk. So professionals understand that we have a term for that. We call it alpha. And we know that there's a breaking point in alpha. We know that we can only decrease risk and increase reward to a certain extent before the whole thing snaps. So finding that sweet spot is essentially what everyone's task is, whether you're an individual investor or an investment advisor or hedge fund. We're seeking alpha. There's a website out there.
Oh, yes.
Whatever. But the point being, to really understand it, we have to compare it to what we know. We can't come in and beat people over the head and say, you don't know what you're doing. Well, they don't understand. And we have to walk back and say, here's what you understand. Here's what we think could make what you understand a little better in shifting risk in your portfolio. Not eliminating risk, not taking risk off the table, but shifting the risk. And then once you've shifted that risk, completely understanding what your trade-off is. In this case, the short put, your trade-off is you're giving up upside on the stock for less downside. And then you move from there. So you have enough to make an informed decision with the comparison to, here's what the put does, here's what the stock does. That's it. Put a PowerPoint slide together, put it in a spreadsheet, take a picture of it, stamp it, timestamp it, throw it up in the air, and that's what it comes down to. And it takes time, but once the people are committed to it, they see the benefit and the value of it. And I really think the entire industry is shifting that way. I think there's a lot of people that have their hands up saying, I don't really know how to manage my risk because I don't completely understand it. And I think, as simple of a strategy as the naked put is, I think a lot of people are just to that point where I know I need a better understanding. I need to assess the risk better. I need to know if the water is clear or dark and murky before I jump into it. And I think we're getting, guys like you in the show, every show that the Options Insider Radio show puts on is, I think, leading the charge to get there.
Well, we like to
long-winded on the soapbox. I will get down now.
We like to think that we're helping a little bit. Thank you for that soapbox, Mr. Cavanaugh. But, you're right. It is a very much an intimidating process to a lot of people, both from the name and from the outlay and how the position performs. Maybe we should just finish hitting up on that. Then, of course, you sell that proverbial 95 put for $1. You collect that dollar as we worked out. If it goes above a 95, you keep that $1 or 1 point or $100 in your portfolio. Now, the other side, the one everyone's so afraid of, is if it drops below 95. Let's say now XYZ drops to 90, and now this is the scenario where everyone's up in arms because you're losing money all of a sudden. So you sold that 95 put for $1. It is now worth $5. Back to the concept we've discussed on previous shows called intrinsic value of that put. XYZ stock is trading for 90. If you could sell that stock for 95, that it has $5 inherent dollars worth of value. So, of course, that put is trading for $5. And so you have a couple of options there. Once again, pun intended. You could allow the options to expire, in which case the put holder that you sold that option to will exercise his option and you will buy the stock for the price of 95. Now, remember, you actually sold it for 1 point or $100. So if you factor that in, you actually bought the stock for the price of 94. And that gets back to what you were saying earlier, Mike, that the selling of the put actually does reduce some of your outlay, some of your initial exposure and risk versus just working that limit order. So, but you still have that 4 point or that $400 loss that you're incurring in any of the different scenarios. Of course, the alternative to that is just buy back the put before expiration. That's what a lot of traders usually choose to do because they don't want to go through the hassle of having the margin and the assignment process go through and acquiring the underlying. But for a lot of advisors out there and asset managers who are going to use the put as a way to get into underlyings, they probably will want to receive the underlying and take delivery. So in that sense, you will allow the put to be assigned and collect the underlying at the price you were working at. And so you can see just from that very clear example of looking at regular plain vanilla limit orders versus something like a naked short put or the, what did you call it? The alternative
stock entry tool.
Yeah, exactly. The alternative, the ASET.
It's like an asset, right?
Exactly. The ASET. But yes, you can see just from that quick comparison of working a limit order versus working a naked short put, just some of the benefits that are obvious from the two different positions and how one can perform versus the other. And in future shows, when we get into spreads and other elements like that, we can talk about different ways to mitigate the overall risk of that naked short put. And there are some interesting ways that you could elaborate on the naked short put and use it to your advantage in an advisory capacity. I know, Mike, you guys over there at KYO like to employ your triple income strategy, a.k.a. what some of us like to know as the wheel of fun. Why don't you illuminate some of our listeners on how you use the naked short put there to start that whole wheel rolling?
Absolutely. And you just, as you were talking, I was writing down, I think a key point about options in general, I think the investing public looks at the option first off as, options are risky. But I think that there's an implied perception as well as the perception of risk is that options are trading vehicles or trading tools. And there's a complete difference between trading and investing. And just for clarification for our listeners, we're talking about using this asset stock entry tool, the ASET, the naked put, the cash secured put, as a vehicle for investing, not trading. So we're not talking about the stories that you see, the high-frequency algo guys with the vol skews and the arbitrage and the volatility fund. No, this is an investment tool that we're talking about, not trading. So I thought it was I just thought it'd be helpful to clarify that we're not talking about options trading. We're talking about using an option to help you with your longer-term investments. I have clients say all the time when we suggest to them, somebody that's new to options, have you ever considered a covered call or a cash secured put. No, I don't trade options. No, I'm not talking about trading options. I'm talking about using it to enhance the return or reduce the risk in your investment portfolio. No, options are risky. Options are for trading. No, so that just for clarification, I will beat the horse until it's dead here, and I will beat the dead horse even more. This is not options trading advice. This is a tool to enhance the return potentially or to reduce the risk in your investment portfolio. So I always try to tell people, don't take my word for it. There's been plenty of research done out there that shows this XYZ 95 put. There's an actual index at the CBOE called PUT, and they show you that because of the volatility skew that favors the put side, that you can actually reduce the volatility in your portfolio a little more than by just being long the S&P with a little enhanced return than just being buy and hold. So don't take my word for it. If you're a buy and hold investor, there are studies done by Ennis Knupp. You can find them at the CBO website that show a buy and hold investor versus somebody that sells a cash secured put on the S&P index month after month after month, having a slightly less volatility in their return with a slightly enhanced return to their portfolio. So as the wheel of fun goes at Know Your Options, the triple income strategy, we use that inherent knowledge that we didn't invent, we just picked up on that, hey, there's a skew to the short-term volatility side, and if we sell a cash secured put to enter into a stock, we're actually, with time, going to enhance our investment portfolio by selling a put, owning the underlying, whether the underlying is an index, a sector-based ETF, or a stock. We could probably make a subsegment of this show to tell people how to really assess risk from the bottom up or from the top down, whether you're going to get less premium for an index than you would on a sector, typically, unless the sector's the utility sector, you're going to get less. You could go on for days. A value stock versus a growth stock where you get all the different nuances and higher returns on volatilities versus less volatilities. On our particular strategy, what we stick to are individual securities. So it's a little bit riskier than doing it on a sector, which is a little less risky than doing it, or a little riskier than doing it on an index. So this is the riskiest of all strategies we have. We sell a put. The most recent one is Exelon, which is, a whopping 2% dividend, and the volatility is not even close to 20. It's a very slow grinding stock. We sell the put. If we don't end up owning the stock, we keep the premium that we sold the put for. If we end up owning the stock, what we do is we look to see when the ex-dividend date is, and then we go the month out after it pays the dividend, and we sell the call at the money. And we just continue to do that in the circle, hence the term Wheel of Fun.
The circle of life, a.k.a. the Wheel of Fun. And you're right, that is one very obvious and very straightforward example for a lot of our listeners of ways they can use that ASET, a.k.a. the naked short put, to leverage or pick up an underlying position. If they do get assigned, then the different ways they could turn around and use what we discussed on the last show, which is, of course, the covered call to generate additional income and maybe perhaps leg out of that position and get in and out. There's a lot of different ways and nuances that you can use when we're talking about these positions. I should also mention, too, you keep mentioning the cash secured put. We should mention what that is for our listeners, which is, of course, an even less risky version of the put. And this is something you can do in non-marginable accounts like an IRA and your retirement account. So it's worth listening for a lot of your advisors out there who deal with a lot of retirement accounts, that you can sell short puts in a retirement account and use that as a way to enter an underlying position, provided you have enough cash in the account to cover the cost of buying the stock if you are assigned. That is what is referred to as a cash secured put, and that is something that is allowed in essentially every IRA and every retirement account out there. So you can do what we discussed last time, covered calls, and you can also do cash secured puts. So these are two excellent ways that you could use these very, very straightforward strategies. As Mike Cavanaugh here illuminated for us, ways that you could use them to improve the overall returns of your portfolio. All right, Mike, I think that's going to do it for the Options 101 segment of this episode, and also that's going to do it for this abbreviated episode of the Advisor's Option. But stay tuned for more episodes of the Advisor's Option in the weeks to come.
The Advisor's Option is brought to you by the Options Industry Council. For more information on how the OIC can help you implement options in your practice, please visit advisor.optionseducation.org. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.